we had stopped last time. We want to move to published accounts, company accounts. I had requested every one of you to take at least 15 minutes to read through the slides that I had shared so that I save time. So let's go straight to the slides that I shared. I'm trying to... Okay, so we can start to welcome back to the class. So we want to go to company accounts. Now, this is the last major part of the syllabus. And again, repeating, the standards I shared with you, the videos, please listen to those videos. I kindly request, especially you can list them. IFRS 16. You can list them somewhere. IFRS 16. IFRS 15. Hello.
A second, sir.
Where did you send?
I did not share the link for the videos. I shared in the groups.
You did on the group.
Yes. So if you don't have, I'll
Only
have to...
one standard.
No. I shared a number.
For Musan,
Now, number 2.
for Musan, it is only one.
It's only one.
Yeah.
I'm very sorry for that. Maybe remind me, I share tomorrow early in the morning or immediately after this class. Sorry for that. I'm not... Is it true? Msanze, have I shared only one?
Only one.
Only one.
Oh, sorry. So please take note of the following. Make sure you listen to the video on IFRS 16. IFRS 16 is leases. IFRS 15, please, I hope you are noting down. IFRS 16, IFRS 15. 15 is revenue from contracts with customers, if I'm not wrong. IFRS 9, I know that one I've not shared. I'm still trying to locate where I had saved it. IFRS 9, I'm trying to locate where I had saved it. IFRS 9 is on financial instruments. IFRS 9 is on financial instrument. And then IAS 20. IAS 20 is on government grants. IAS 20, those are the major standards. Others I'll just highlight as we wind up. So this is the last major topic we are covering. So please make sure you familiarize yourself with these topics very well. So without taking much time, let's move on because I had told you to take 15 minutes to read through. Now,
can you repeat those FRS?
IFRS 9, IFRS 9, IFRS 16. I'm repeating IFRS 9, IFRS 16, IFRS 15, IAS 20, IAS 20, IAS 36 and 38. 36 and 38. IAS 36 and 38. By now, I hope you have already read IAS 12. IAS 12, I hope by now everyone has read. IAS 12, income tax. IAS 12. Now, if you don't have, anybody don't have, you can just go to YouTube and type my name, Charles Omanyo. You can get one of the classes you have. But again, after you do your exams, I'll remove them from my YouTube because they are not edited. So after you do your exams, I'll remove them from YouTube because they are not what? Edited. So you can just type my name, Charles Omanyo, all of them. You can get them in YouTube. Is that okay? Charles Omanyo. So through that, anything you need, I'll be posting there if you just type the name. But immediately after your exams, I'll pull them down. Are we together?
Yes.
Okay, fine. I'll pull them down after exams because they are not edited. Okay. And it has some people talking, etc. So let's go to this chapter, company accounts. Now, in this chapter, we are going to cover the following: accounts for companies, that is published accounts. We will cover public sector accounts, branch accounts, consignments account, accounts of insurance companies and banks, accounts of professional firms, and farming accounts. All our remaining classes, you note that in Kigali, we are only remaining with 1 weekend. So we had agreed on that week on 21st, we'll be meeting for revision. So I want to try within the remaining time to cover these accounts. Msanze, we are remaining with 2 weekends. This coming weekend, and there is another weekend. But Kigali, it's only 1 weekend. So the semester was very short, very, very short. We did not even get chance to do assessments because the semester was very short. Now, these are the accounts we are going to pass through. Now, what I'm covering today is mostly for first timers. And I'm not saying that second timers, it's not important. It's very important because it lays the background. These are the accounts we are going to cover. Now, why don't we start with company accounts? So whatever I told you to read, I'm just skimming through them. We have 2 types of companies. We have what we call private companies, and we have, okay, let's start with a company. A company is any business whose ownership is in the form of shares. Any business whose ownership is in the form of shares, we call it a company. So when the ownership of a company is in the form of, when the ownership of a business is in the form of shares, we call it a company. Now we have 2 types of companies. We have what we call public companies. Let me just project slides so that I just talk as I pass through. We have 2 types of companies. We have private companies and public companies. I'm just guiding you in reading on this because I had told you to read on it earlier. So private and public. Private and public. Now, whether it's a public company or a private company, ownership is always in the form of shares. Ownership is always in the form of shares, regardless of the type of company. Let me just admit some people. Okay, so what in a private companies don't buy and sell their shares in Rwandan Stock Exchange market. In other words, they don't trade their shares in the stock exchange market. Private companies are not listed. So nobody can buy shares there. It's just the few owners who are there are the ones who are shareholders. Nobody can buy, no outsider can buy shares in the company because they don't sell their shares in the stock exchange market. Now remember, private companies are abbreviated with the letter LTD. So if you see any company with the letter LTD, you know it's a private company and it does not trade its shares in the Rwandan Stock Exchange. In other words, it's a company that is not listed. Public companies are companies that sell their shares in the stock exchange market. Now, public, if you want to know a public company, it ends with the word PLC. For example, Bank of Kigali PLC, Equity Bank PLC, etc. Now, these public companies, initially, they were private and then they are converted into public. How are they converted to public from private? By giving what we call an IPO. An IPO is when you want to issue shares for the first time. It's called an initial public offer. When you want to offer shares to the public for the first time, the process you go through in the Rwandan Stock Exchange market in cooperation with the CMA, Capital Markets Authority. So in that case, for you to change from private to public, you must pass through what we call an IPO. In managerial finance, there is what we call primary markets and and secondary markets. So for you to transit from private company to public companies, you must pass through, in managerial finance, we call it primary market. In primary market is when you are trading shares for the first time. Okay. Now, ownership of companies, we have said it is in the form of shares. We have two types of share capital. Preference shares, I don't need to explain that because I had told you to read. And ordinary shares. Remember, preference shares have a fixed rate of dividends, whether the business is profitable or not. Just allow me to skim very, very fast, but no questions here until we start calculations because I told you to read. So preference shares, they have a fixed rate of dividends. Now, whenever we are to pay dividends, we pay preference shareholders first. Preference shareholders are not allowed to vote in the meetings of shareholders. So they don't have what we call voting rights. On the other hand, ordinary shareholders are paid after the preference shareholders. That is why we call them, they are subordinate to preference shareholders. However, ordinary shareholders are only paid if the business makes profit. If the business does not make profit, ordinary shareholders will not gain. However, if the business makes a lot of profit, ordinary shareholders will gain, because what remains as dividends after paying the preference shareholders, it is taken by the ordinary shareholders. This is important, classes of share capital. Now, when a company wants to issue shares for the first time, there is this amount of shares that a company is legally allowed to give out. The amount of shares legally allowed to give out is called authorized share capital. The number of shares a business is authorized, is legally allowed to give out. For example, I don't know, yeah. Here, for example, look at that example. A company may be registered to have 100,000 shares, and the value of one share is what? 100. So in this case, the value of the shares will be 10 million. So legally, my company, I'm just using my company as an example, my company is allowed, the value of the shares should be 10 million. So that one, we will call it authorized share capital. Now, because we issue shares so that we raise capital, we raise money. So when you are legally allowed to have 10 million shares worth 10 million, you cannot give out all of them at the same time, because in future, you may want to issue new shares. So if you are legally allowed to issue 10 million, you may decide that immediately I will only issue 50,000 shares, so that in future I have a room to issue an additional what? 50,000. So out of 100,000, which you are legally allowed to issue, legally that is authorized, you may decide to give out how many shares? To give out 50,000. What you give out at a given time is what is called issued share capital. So if I was legally allowed to give out 100,000, but I gave out how many shares? 50,000. 100 will be authorized. The 50 that I give out will be called what? Issued share capital. Now, I have given out 50,000 shares, and the value of each share is 100. But you know that shareholders, sometimes they don't have money. So you want them to buy, but you also recognize they may not have enough money. So you tell shareholders that out of the 50,000, at a price of 100, immediately you may give me 75 for every share. And then the remaining 25 for every share you will give me after 1 month. I'm repeating, issued share is now 50 at 100. Now you tell the potential shareholders that, yes, I'm issuing 50,000 at 100, but I want that immediately, because I recognize you may not have enough money. Instead of paying me 100 per share, you can immediately pay me 75 per share, and then the balance you give me maybe after 1 month when you get the money. So what you ask the shareholders to pay immediately is known as called up share capital. Called up share capital. What you have asked shareholders to pay immediately is known as called up share capital. I've given an example there. Maybe you call up 60 out of 100. So 40 is what you will call up later on. It is known as uncalled up. What you tell them that you can pay after 1 week or after 1 month is known as uncalled up share capital. And finally, shareholders, you've even told them don't pay 100, pay 75 immediately. And then when it comes to paying, you still find they have not paid the 75 you had agreed. Maybe he had promised he'll pay 75, but he ends up paying 50. He tells you, I thought I had this money, but the money was not enough. So what the shareholders actually pay is known as paid up share capital. What they do not pay is known as unpaid up share capital. So when we talk of classes of share capital, we have what is known as authorized, issued, called up, uncalled up, paid up, and paid up. Now, how do we issue shares? We have said you don't issue authorized because in future you may need more shares. So there is what we call issued share capital. Now, how do you issue shares? There are 3 ways of issuing shares. I'm trying to manage my time. There are 3 ways of issuing shares. Number 1, you can issue shares at full market price, where the value of each share was in the market is 100. And you decide to issue the shares at the full market price of 100. In that case, if the current market value of your shares is 100 and you issue shares at a price of 100, we say that you have issued shares at full market price. We say you have issued shares at full market price. Now, for example, if you issue shares at 300, I'm now changing. If you issue shares at a price of 300 per share, that will be the market what? Price. But there is that original price that is shown in the balance sheet, what we call book value of the shares, or what we call the nominal value of the shares. That original price at which you issued shares before the value of the shares increased is known as nominal price. The nominal price is the price that is normally shown in the balance sheet under share capital. Now, when you issue, if the nominal price, for example, is 100 and the market price is 300, I'm again repeating, if the balance sheet value, the nominal value, also known as the book value, is maybe 100 per share, and the market value, current market value of the shares is 300, and you decide to issue new shares at 300. So which means you have issued shares at a price more than 100, which is nominal. Now, when it comes, you have received a total cash of 300 times the number of shares. Now, the total amount you have received is cash. So you will debit cash because you will receive the money when you issue shares. Now, your capital will also increase. So you debit, when capital increases, we all know it's a credit entry. Cash has increased, but your capital has also what? Increased because you have issued new shares. So that's a credit entry. Now, shares at nominal price goes to share capital. Shares at nominal price is taken to share capital. I will give you an example, don't worry. I'll give an example. Shares at the price above nominal. For example, if you issue at 300 and the nominal was 100, 200 is above the nominal. The amount above the nominal is called premium. It is taken to the share premium account. I will give an example later on. What is the second way to issue shares is by what we call rights issue of shares. What is a rights issue of shares? It is issue of new shares to the current shareholders, issue of new shares to the current what? Shareholders in proportion to their current shares at a price below market price. At a price below market price, but above the nominal price. At a price below market price, but above what? Nominal price. Nominal price was 100. Market price was 300. When you issue new shares to shareholders, maybe at a price of 250, you have issued at a price below the market price to the current shareholders in proportion to their current shares. That's called a rights issue of shares. It is called a rights issue of shares. So also in a rights issue of shares, you debit cash, you credit share capital, and you credit share premium. The last issue of shares is known as bonus issue of shares. Bonus issue of shares is issue of new shares to the current shareholders in proportion to their current shares for free. They don't pay anything. You issue shares for free. So when you issue shares for free, the challenge is there is no cash received. That is the challenge we have. There is no, if you issue for free, there is no cash the business is receiving. So this can be accounted for from share premium account or any other account you have been told. So because there is no cash, you debit share premium. You remove it from share premium, the current share premium. So you reduce share premium. When share premium reduces, you debit. And you credit share capital because shares will increase. So when there is a bonus issue of shares, what is the effect? You debit share premium and you credit share capital. Now, those are
Sorry,
just,
sir.
yes.
What if the balance of share premium is below the bonus issue? What will be the effect?
You can go to any other form of reserve. There are many reserves. You can take it from revaluation reserve, from retained earnings, from any other. The balance can be picked from any other type of reserve.
Okay.
Okay, let's continue. So have you understood me? It can be cleared from any other type of reserve. Now, there is a question here that I want to take the shortest time possible to summarize the three. To summarize, number one, issue of shares at full market price. Number two, rights issue of shares. And number three, bonus issue of shares. There is that question there. The question reads, let me read it from this first before I go to Excel. Now we have this Rusizi Limited. Okay, before I continue and before I forget, I want Msanze students to respond. Msanze student, do we have any class on Friday? Because I was proposing we also meet on Friday online.
No.
Can we meet on Friday online?
Yes.
Okay.
Friday, we are Friday.
Yes, we are ready.
You have a class?
No class.
No class.
We are ready. We are ready.
Okay.
No,
I hope
we are ready.
the students responding. Okay. You know, so the people saying we are ready, they may be from Kigali.
No.
So,
We are from Musanze.
okay, fine. So if Musanze are okay, Kigali have confirmed they don't have a class. I was just confirming with Musanze. So we are meeting on Friday also. Just remember Friday at 6:30. Friday at 6:30. Okay, let's continue. So this question reads, Rusizi is a limited liability company with 400,000 shares valued at 100 each in issue. So it's 400,000 and the value of each share is 100. At 1st January 2020, the balance in the share premium account was 35 million. The market price of the shares was 150. So the 100 you were told earlier, that we call it nominal price. The market price is 150. The following transactions occurred in the year ended 31st December 2020. 1st April, we issued 100,000 new shares at full market price of 150. On 1st July, there was a fully taken up to for 5 rights issue. The issue price of the rights was at 120. So 120 is below 150. So if we issue shares at a price below the market price, but above the nominal, market price is 150, nominal is 100. We have issued it at a price of 120. That's the rights issue. On the 25th September, there was a 2-for-7 bonus issue made using the share premium. So from the share premium account. So what are the balances on the share capital and share premium? Why am I doing this? This can be just one additional information in company accounts. You see, in company accounts, you may have as many as 10 additional information. So this is just one additional information which will affect your equity. It will affect your equity. So it's important to know how to account for it because it will affect your equity. So let me take the shortest time on that. Now, I want to be systematic in this. So in my solution to this question, I want to start with beginning of the year. Beginning of the year. Please let's mute. Beginning of the year. Beginning of the year 2020.
Sorry, Victor, may increase the indent.
Yes?
May increase the indent in order to see what you have.
I increase the size.
Yes, the size.
Okay. Is that better? It's okay.
Yeah.
Okay, fine. Now, at the beginning of the year, so I'm starting my transactions by looking at number one, what happened at the beginning of the year. So at the beginning of the year when we started, we want to look at what were the number of shares. Number of shares at the beginning of the year. How many shares did we have at the beginning of the year? 400,000. I hope everyone is seeing the 400,000. So we had 400,000 shares. Now, valued at what? 100 each. So which means, what was the value of the share capital? Share capital value is equals to 400,000 shares times 100. So it gives us a certain amount. Now I've increased the size, so I'll be forced to scroll, but it's okay. So it gives you 400,000 times 100. So that is the value of, so it is 40 million Rwandese francs. That is the value of the share capital. And you are being told at 1st January 2020, the balance on the share premium balance on the share premium was 35 million. 35 million Rwandese francs. So which means at the beginning of the year, the number of shares were 400,000. Share capital was 40 million and share premium was 35 million. Now, the market price of the shares, so let's come, so that is at the beginning of the year. So let's come to number 2. On 1st April 2020, what happened? There was issue of shares at full market price. Issue of new shares at full market price. Do we agree that is what happened on April? On 1st April, issued 100,000 new shares at full market price. They issued new shares Number of new shares. So what is the number of new shares? What happened on 1st April? We issued new shares. What are the number of new shares? On 1st, issued 100,000 new shares at full market price of 100,000 at full market price of 150. So what are the new shares? 100,000. I hope everyone has seen that. Shares. And these shares were issued at a price of 150. Issued at a price of 150. So in other words, the market price is 150. The nominal price is 100. So it was issued at that price. Issued at that price. It was issued at that price. I mean price. Issued at that price. Now, how much cash was received? Cash received from issue is equals to, we issued 100,000 shares at 150. So what is the cash received? It is 100 times 150. So it is 15 million. Now, what is the double entry?
Excuse sir, those 100 shares are from where?
Which one?
The number of new shares.
On 1st April.
Okay.
Okay.
Yeah.
Are we together up to there? So we said when we issue shares at full market price.
What about 100 nominal price? 100.
The price we started with here.
Is it given? Okay. Yes.
Okay. But remember, we did not issue at 100. We issued at 150. Do you agree?
Yes.
Yes. So what do we debit? We have said you debit cash. We agree? And we said there are two credits. Credit, share capital. Share capital is 100,000 times 100, the nominal price. Share capital is posted at the nominal price. And then the balance goes to, where?
Share premium.
Share premium.
Share premium. The balance. What is the balance? 150 minus 100.
Yes.
So the balance goes to the share premium. So what has gone to the share capital? It is 100,000 times 100. What has gone to the share premium? It is 100,000 times 150 minus 100. So that is. So do you see when you add what went to the share capital plus what went to share premium, it adds up to 15 million. Now, please let's listen attentively here. What are the total number of shares after 1st April? What is the total number of shares? How many shares did we have before 1st April?
400,000.
400,000. How many new shares have we added? 100. Do you agree? So what is the total number of shares? It is 400,000 shares plus 100,000 shares. So that gives you whatever amount you get. So that gives you 400. I always like picking it from where it was plus 100. So it gives you what? 500. What is the total share capital? What is the total share capital? Total share capital, what did we have at the start? 40 million. Do you see 40 million?
Yes.
And then we have added, what is the new share capital? 10 million. Do you see 10 million?
Yes.
So what is the total? 40 million plus 10 million. What is the total? 50
Million.
plus 10 million.
I think 10 million is an amount, not a number of shares. It is 100,000.
I'm talking of an amount. Total
yeah,
share
okay.
capital is an amount.
Yeah,
Let
it's
me write
okay.
there.
Yeah,
Rwandese
it's okay.
francs.
Yes.
Is that okay?
Yeah, it's okay.
I'm talking of number of shares is number. The first one is number. Now I'm talking of share capital.
Yes, I
Okay.
got it.
So we have 40 million plus what? 10 million. So that gives you what? This was shares. This is money. Now, what is the total share premium? Total share premium will be equals to, what did we have at the beginning? 35 million. And then we have added 5 million. So 35. And then we have added 5 million. So that will give you 35 plus 5 million. That will give you 40 million Rwandese francs. So do we agree these are the values we have after that particular date?
Yeah, sure.
Okay, so I'm done with that date. I want to go to the next date. So I'm done with 1st April 2020. 1st April 2020. So let's go to the next date. We see what happened. Next date is 1st July. There was a fully taken up to for 5 rights issue. So 1st July, that is number 3. Number 3, 1st July 2020. What is it? Rights issue of shares. Rights issue of shares on 1st July. Rights issue of shares. Rights issue of shares. What was the rule? Can you remind me? First, 2 for every 5. At a price of what? 120. 2 for every 5. 2 for every 5. So 2 new shares for every 5 at a price of 120. 120 per share. Now, can I ask a question? What you are still seeing there in the screen. How many shares did we have before 1st July? How many shares did we have?
500.
Are we all seeing what
You
I've
had
selected?
500 shares.
Thank you. Now, how many? What is the rule? 2 for every 5. So, what will be new shares? Number
100
of new
shares.
What will be the number of new shares? Look at what I'm doing. It will be 500 shares times 2 divided by 5. 500 times 2 divided by 5. So what are the number of new shares?
200.
So I'm just trying to be slow there. Times 2 divided by 5. So it is how many shares? 200,000 new shares at what price? A price of 120. So what will be the cash received? Cash received will be equals to 200,000 shares times 120. So what will be the cash received? It will be 200 times 120. That gives you 24 million Rwandese francs. Now what do you do there? You debit cash. Debit cash of how much? 24 million. And you have two credits. Credit share capital of 200,000
Times 100.
times what? 100.
100.
Thank you. Times 100. So that will give you 200,000 times 100. It gives you 20 million. What do you else credit? Credit what? Share
Premium.
premium. How much? 200,000 shares times
20.
120 minus 100.
100.
So how much is that? 200 times 120 minus 100. 84 million. So do you see, when you take 20 plus that, it gives you what? 24. That is a double entry. You know, credit should always be pushed in. That one we learned in financial accounting. Okay? Now, what are the...
Excuse me.
Yes.
When do we consider the weighted average number of shares?
When you are calculating EPS. Have I answered
I was
you?
confused. Yeah, confused.
When you are calculating EP,
Basic and per share.
yes. Please
Yes,
don't calculate weighted here. Don't calculate weighted here. Weighted is calculated when you are calculating what? EPS. What is EPS? Profit attributable to ordinary shareholders divided by weighted average number of shares.
Yes.
Thank you. Okay, let's continue. So, what is the total number of shares? Total number of shares. Where did we stop? We stopped at 500 and then we have added 200 new. Do you see that? 500,000 shares plus 200,000 new what? Shares. So what is the total number of shares? Is equals to the 500 plus the 200. So it gives you what? 700. What is the total share capital? Where did we stop? 50 million. Do you see 50 million? And then we have added 20 million. 50 million. And then we have added 20 million. So that will give you 50 plus 20. It gives you, these are shares, and this is 7. So what is the total share premium? Can somebody help me in total share premium?
40 million
Plus?
plus 40.
Plus 4. Yes, thank you.
44 million.
40 million plus 4.
Nese ushaka gukora neza.
4
Weka
million.
mu makuru.
40 million plus 4 million.
Iyo ndiko ndabivuze.
Please, let's meet. So that gives you 44 million. So we are done with the rights issue. That is rights issue of shares. Lastly, we go to, which is the next date? The next date is 25th September. There was a 247 bonus issue made using share premium. 247 bonus issue on 25th September. So on 25th September 2020, there was a bonus issue of shares. So what was the rule? 2 new shares for every 2 new shares for every 7 shares for free. Bonus is always for free from share premium account. You remove it from share premium account. Now, bonus, even though it is free, bonus is normally priced, valued at the nominal price. In other words, there is no money you are receiving, but when you are accounting for it, you account for it at the nominal price. But there is no money you are receiving. But when you are accounting for it, you account for it at the nominal price. So what will be the new shares? New shares, new number of shares will be equals to, new number of shares will be equals to, where did we stop? 700,000. 700,000 shares, we are being told times 2 divide by 7. That was the rule. 2 for every 7. 2 for every 7. So what do we have? 700,000 times 2 divide by 7. So what does it give us? Again, 200,000. It's 32. Yes, 200,000 new shares. New shares.
Excuse me.
Yes.
Some people requesting to join.
Okay. You know, when I get into teaching, in the spirit of teaching, I even forget there are other people. The problem is when I put full screen, I cannot see what is happening in the background. So whenever there is somebody, and you just post in the group, if somebody sees, he notifies me. Okay, thanks for notification. I always put full screen so that everyone can see a bigger screen. So number of new shares is 200,000 shares. Now, what is, do we have any cash received? Cash received is?
No cash received.
0. Do you agree?
Yes.
No cash received. So what is so what will we do? So what is the value of the bonus? We have said bonus is valued at what price?
Nominal price.
So you take the 200,000 shares times the nominal price is 100. So what is the value? It is 200,000 times what? 100, which gives you 20 million. Now what do we debit? Debit share premium. In other words, you are reducing the share premium. When you are reducing the share premium, you debit. And credit what? Share capital. Share capital. So debit share premium of 20 million and credit also share capital of 20 million. Now, what is the total number of shares now? Total, here is where we be attentive as we finish here. Total number of shares. What are our total number of shares? 700,000 plus what? 200,000. So 700,000 shares plus 200,000 shares. So that gives you 700,000 plus 200,000 is 900,000 shares. The total. This is what will go to your balance sheet as number of shares. What will go to your share capital? Share capital. What will go to your share capital? 70 million plus 20 million. 70 million plus 20 million. So whatever we get is 70 plus share capital 20. Run this France. What will go to the share premium? What will go to the share premium? What was the previous share premium? You see 44 million. You see 44 million?
Yes.
What do you do?
Minus.
Minus.
This the share.
Because you debited share premium.
The
So you
bonus
minus what?
20 million.
20 million. So share premium in the equity in the balance sheet will reduce. So is this 44 minus what was debited? 20 million that was debited. And this what? That is issue of shares.
It seems that there are others who are knocking, sir.
Let me check. I'm not seeing any who is knocking.
They were writing on a WhatsApp group.
Maybe if they are the previous ones. They are writing on the WhatsApp. I'm not seeing anybody knocking.
Let's continue.
Okay, fine. Now, that is issue of shares. Issue of shares. Okay, now let's continue. So we reserves. Let me take 2 minutes on reserve and then I finish with some calculations on tax. I told you to read on, but I may take some 20 minutes or so on tax so that on Friday when we meet, we start preparing financial statements. So reserves. What is a reserve? A reserve is a resource kept aside. You know, in your business, you should keep some resources aside to help you in future. We have two reserves are classified into two groups, either capital reserves or revenue reserves. Capital reserves or revenue reserves. There are three types of capital reserves: share premium, capital redemption reserve, and revaluation reserve. What do we use share premium for? Share premium is a reserve, first of all, created when you issue shares at a price above the nominal price. When do we create share premium? When new shares are issued at a price above the nominal price. The extra amount above the nominal price goes to the share premium account, which is a reserve. It can be used to pay bonuses in future, as we have just seen in what you have done. This reserve can be used to pay bonuses in future. What is a capital redemption reserve? These are reserves that you create to enable you buy shares back, buy back shares from shareholders. Sometimes you want to buy shareholders' shares. You don't want a particular shareholder. So if you don't want a particular shareholder, you can buy back their shares. So from what? You must have a reserve that can enable you to buy back what? Shares from shareholders. It is known as capital redemption reserve. We also have revaluation. Hello? We also have revaluation reserve. What is revaluation reserve? This is a reserve that is created when non-current assets value has increased above the net book value. When the non-current assets value has increased above the net book value or above the carrying amount. We post the increment in a reserve called what? Revaluation reserve. So this share capital, capital redemption reserve, and revaluation reserve, they are known as capital reserves. We also have another category of reserves called revenue reserves. So revenue reserves, we have retained earnings and general reserves. Everyone, I think, knows what retained earnings are. When you plow back the profits that we have made back to the business, that is retained earnings. And finally, there is a reserve that you just call it a general reserve to help you in the future without any specific purpose. You can just have some reserve to help you in future for anything unforeseen. Any unforeseen expenses. You can use it for any unforeseen expenses. However, this reserve is mostly used to acquire new non-current assets. When you want to buy a non-current asset, most likely you buy it from the general reserve. Now, when we ask for types of reserves, don't talk about capital and revenue. When you have been asked for types of reserves, there are 5 types of reserves. What are the 5? Share premium, capital redemption reserve, revaluation reserve, retained earnings, and general reserve. So if you have been asked for types of reserves, there are 5. Share premium, capital redemption, revaluation, retained earnings, and general reserves. Now, there is a statement we will see on Friday known as statement of changes in equity. Statement of changes in equity accounts for all these reserves plus share capital. When you take share capital plus all the 5 reserves, they are posted in statement of changes in equity. Types of reserves, I've already explained that. Finally, for today, for the next 30 minutes, let us look at income tax, which I had told you to read on. Did I tell you to read on it? So I just want to summarize it, and then we go to format and we end the class. Now, we always have a challenge in income tax. The problem is, by the time you are preparing financial statements, the business does not know the actual amount of tax they are to pay. By the time financial statements are being prepared, by end of your period, you still don't know the actual amount of tax RRA will ask you to pay. Therefore, when you are preparing the income statement and the balance sheet, you are relying on what we call estimates, because you don't know what you'll be asked by RRA later, because RRA must look at your books before they bill you. So in that case, you don't know how much tax you'll be asked to pay. Therefore, you always rely on what? Estimates. That is the main challenge that we have in tax. Estimates. Because you may estimate wrongly. Maybe you have estimated that the tax you are to pay is 1 million. And then you find that the actual amount of tax you are being asked to pay is 1.2 million. Or you have estimated that the tax you are to pay is 1 million. Then you are being asked to pay 900,000. Let me start with the first one. You have estimated the tax to pay to be 1 million. And then you are being asked to do what? To pay 1.2. You estimated 1 million, you're being asked to pay 1.2. In that case, we say you have underestimated. Why have you underestimated? You estimated 1 million and you are asked to pay how much? 1.2. So when in that case, what is estimated is less than the actual, we call it underestimation or under provision. Number 2, you may have estimated 1 million and you are being asked to pay 900. So in that case, we say you had overestimated. Now, how do you account for the underestimation? Remember, I told you to listen to those videos. They should have helped you. Now, how do you calculate the tax to take to the balance sheet and the income statement? You find your estimate of the year for the tax, you will see an example. You add underestimation of the previous year. Maybe last year you had underestimated. So if there is underestimation, you add, because you had estimated 1 million, but the actual was 1.2. So you underestimated with what? 200,000. You add underestimation of 200,000 to this year's estimate. If it is overestimation, you less it. So there is estimate of the year, add underestimation, or less. Please, tax is very important in published accounts. These workings normally confuse if you don't get it very well. So you have estimate of the year, add underestimation of last year, or you less what? Overestimation of last year. So what you get there is what goes to the income statement. But without taking much time, let me give you two examples. One on this, what I'm talking about, and the other on the part.
Excuse me, sir. Excuse me, sir.
Yes.
I'm sorry to ask you some question about taxation. Sometimes we have seen in the taxation that there is some wide computing income tax. There are some expenses that are considered as non-allowable expenses. So what I'm asking myself, why are we not considering them while doing this in our, as far as
Can I answer
reporting
you
is
that question
concerned?
when I reach deferred tax, please?
Yes.
Okay. There are those allowable and non-allowable. For example, entertainment allowance. If you give entertainment allowance to the CEO, the taxman does not recognize that. Yet in your accounting profit, you recognize it as an expense. Are we together? So the taxman says that is you are just taking advantage. You are just trying to reduce your profits so that you reduce the amount of tax to pay by providing entertainment what? Allowance. So there are some allowances that the taxman does not account for when they are calculating tax. Yet in your books, in your accounting profit, they were what? Allowed. But the taxman, when the taxman is calculating his tax, he does not. But let me hold that until I reach deferred tax. However, I told you to read on this, to listen to the video, but I'll come back to it. Let's read some two examples. One on deferred and one on normal current tax, and then we will end. So let's read the first question. Rusizi estimated last year's tax to be 50 million. As it happened, the tax advisor settled with the tax authorities 40 million. This year's estimate, let me be slow again. Rusizi Limited estimated last year, estimate of last year's tax to be 50 million. As it happened, the taxman settled with the tax authorities how much? 40 million. So these people estimated 50, but the actual was 40. Did they underestimate or they overestimated?
Overestimated.
Over.
Under.
Over. Why is it over? They estimated 50. They actually paid what? 40. So 40. They overestimated. The key word there is estimate. They overestimated.
That is over.
They overestimated. Now, if it is an overestimation, you less. You will see what I mean by you less. If it is underestimation, you do what? You add. So you are being told this year, Rusizi estimates their tax to be 55 million. But they are little confused as to how they should reflect this. Now, if this is an additional information on its own like that, how do you account for it? Let's go to Excel. We account for it. So these are the things I told you to read on, to listen to the video. Solution. Now, the same question. So we have said, what is the estimate of the current year?
50 million.
Estimate of, not of last year, current year. Estimate of current year?
55.
55. Thank you. 55. Tax estimate is 50. Let me put it here. 55. 55. Now, was there overestimation or underestimation last year?
Over.
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 We have said if it is over, you do what? You less.
Less.
Over estimation last year. Last year is the previous year. So what is the overestimation? Let me put it in bracket. What is our overestimation? It is 50 million minus what? 40 million. So 50 minus what? 40. So it gives you what? 10. So what are we learning? If it is over, you less.
Less.
Are we together?
Yes.
So what is the income tax for the year? Time is really moving fast. So if you less, it will be 55 minus 10. So 45. Please note, this 45 is what goes to the income statement. Income? What do you mean by going to the income statement? When you are preparing the income statement, there is sales minus cost of sales to give you gross profit, minus expenses to give you profit before interest, minus interest to give you profit before tax, and then you minus 45. Are we together? That is what you minus in the income statement. This estimate of the year, it goes
Financial position.
Goes to statement of financial position as current liability. So there will be a current liability. So estimate of the year is a current liability. Is a current liability. When you take estimate for the year plus over provision, it gives you. Now, please allow me not to do the second example. I'll just share with you. The second example is when there is under. Because of time, I want to go to deferred. Are we together? When there is under, what do? You add. Are we together? When do we have under? When estimate of the year is less than the actual. When do we have under? When estimate of the year is less than the actual. Now, in deferred tax, I'm assuming you people you read. Let me go straight to an example. If I start giving background, I will not finish. So let's read this question, short one, and then we will give. I'll use the question to explain everything I need to explain. Now, deferred tax, just for 2 minutes, deferred tax is known as future tax. The tax to be paid in future. Deferred tax is known as future tax. Now, in deferred tax, which is also future tax, there is always, this deferred tax is caused by what we call differences between accounting profit and taxable profit. There is what we call accounting profit and there is what we call taxable profit. The question that person had just asked me, that there are some allowances given, there are some allowances not given allowed. So the differences between accounting profit and taxable profit is what results to what? Deferred what? Tax. It gives rise to deferred tax. Now, why is there a difference between accounting profit and taxable profit? Why do we have differences? Because there are some expenses that the accountant allows. And those expenses are not allowed by the taxman. There are some expenses when the accountant is preparing his income statement, he gives it as an expense. But when the taxman comes to audit, he tells you, this one we don't recognize it. So due to those differences, they cause what? They cause deferred tax. But what I've said, those are called permanent differences. What are permanent differences? Permanent differences are those that the taxman tells you this one we don't allow. But we also have what is called temporary differences. You can find out temporary differences. Temporary differences are differences which arise as a result of the rates that are used, which arise as a result of the difference between the capital allowance and the depreciation. You can read on it. I'm only remaining with 17 minutes to do this calculation. Now, there is what we call when the taxman is calculating his tax, he bases it on what we call tax base. Tax base. When the taxman is calculating his profit, he bases it, he calculates it based on what? Tax base. What is tax base? Tax base is cost of an asset minus capital allowance. Cost of an asset minus, I'm just trying to summarize, cost of an asset minus capital allowance. What is capital allowance? Allowance that the taxman gives you on non-current assets you've acquired. So when you acquire a non-current asset, the taxman will give you a discount. You will not pay tax on that discount that you have been given. That discount is what I'm calling an allowance. You will be given some relief, if I use another word. The relief that is given on non-current assets by the taxman is called what? Capital allowance. Now, the accountant does not look at capital allowance. On the other hand, the accountant looks at depreciation. When we acquire an non-current asset, the accountant looks at loss in value, which is depreciation. Now, the accountant, when the accountant takes cost of the asset minus depreciation, the accountant calls it carrying amount. Carrying amount. So when the accountant takes cost of the asset minus accumulated depreciation, the accountant calls it carrying amount. Now, when the taxman takes cost of the asset minus capital allowance, the taxman calls it what? Tax base. Now, there is always a difference between the carrying amount and the tax base. The difference between carrying amount and the tax base, if we multiply it by the tax rate, that is what gives you the deferred tax. So that is what we want to do in this question. And then I just show you how you will account for it in the income statement and how you will account for it in the balance sheet. And we stop with it on Friday.
Excuse me.
Yes.
How is the carrying amount different from the net book value? I want to get clarification on the two.
In this context, it is the same.
Okay.
Carrying amount, I've said in the context of tax, it is the same. But remember, carrying amount, ideally carrying amount should be cost of the asset minus accumulated depreciation minus any impairment losses. Are we together?
Yes, that's the carrying amount.
Yes, that's the carrying amount. So if you ask me, what is the difference between carrying amount and net book value? The answer is carrying amount is cost of the asset minus accumulated depreciation minus impairment loss. Net book value is cost of the asset minus accumulated depreciation. But if there is no impairment loss in a equation, carrying amount is the same as net book value. Have I answered you?
It's okay.
Okay. So you are being told the following information relates to X Limited. Let's take this note seriously. Cost of an asset is 40,000. Depreciation is 20%. Residual value is 0. Capital allowance. What is capital allowance? The allowance that the taxman gives you on the asset you acquired. The allowance that the taxman gives you on the asset you acquired. So capital allowance in the first year is 50.
Chair, will you pass the screen, please?
Yes?
Chair, will you pass the screen?
It is shared, my dear.
Okay.
He's not saying. Now, this is the time we always say, on a light note though, don't say that this person is talking bad. This is the time we tell you don't use your phone, please. Okay, let's continue. Okay, so in short, the screen is there. Maybe you are the one who is not seeing it. Can we all mute, please? We are remaining a few minutes. Now, in my solution to this question, now these people are messing us.
Mute those persons, sir.
Let me mute them. You know, I don't want to go back.
Thank you.
Okay, so the following information relates to X Limited. Cost of the asset is 40,000. So I can pick it because that is a picture. Let me just pick cost of the asset is 40,000. X depreciation is 20%. So we can get the depreciation a year. A year is what? 20% times 40,000. Let's be extremely attentive here. Deferred tax is normally complicated sometimes. That is 40,000 times 20%. So depreciation, remember this is per year, per annum. Now, capital allowance, they were different. There was a first year is equal to 50%, goes times 40,000. Whatever amount we get. So that gives you 50% times 40,000. It gives you 20,000. But in the second to the fifth year, second to what? Fifth year, we are told it is 12.5%. Of course, times 40,000. Whatever value we get there. So that in the second to fifth year, it will be 40,000 times 12.5%. So I believe everyone sees what I've done. Now, when you want to account for it, you come and have a table. I always advise you to try to master that table. We come and have a table there that shows the period. And next column is carrying, what somebody was asking me, carrying amount. The next column, we have what is called tax base. Tax base. This format is very, even if it's an additional information, just do that and you will always turn out to be right. Difference, and deferred tax. Deferred, the last column to be deferred tax. So I'll have a table like that. Let me wrap. Okay. Now I've wrapped it. What is carrying amount? Let me just use abbreviation. Cost. Sorry. What is the carrying amount? It is cost minus what? Accumulated depreciation. What is tax base? It is cost minus
capital allowance.
Capital allowance. Please, I really plead with you people, understand this table. This table is very important in any tax, even if it's just additional information. One. Now you show your periods. The first, when you acquired the asset, we call it year 0. It was for 5 years. You see year 1 to year 5, or the depreciation is 20%. 20% is the same as 5 years. So we have year 1, year 2, year 3, year 4, and year 5. Now, what is the cost of the asset? What is the carrying amount of the asset in year 0? Year 0, we have not started depreciating. Do you agree?
Yes.
We have not started depreciating. What is the difference? 40 minus 40. What is the deferred tax? The rate was 30%. So this is 30% times the difference. Yes. Okay, let's continue. Now, at the end of year 1, what is the carrying amount of the asset? It is 40,000. You see 40,000? Minus depreciation of the first year is how much? 8,000.
80.
We agree. So the
Yes.
carrying amount is 32. Has everyone seen the 32?
Yes.
Cost of the asset minus depreciation. What is the tax base? Tax base is 40,000 minus the capital allowance. In the first year was 20,000. We see 20,000?
Yes, 50%.
Yes, 50%. 20,000. What is the difference? 32 minus 20. So the difference is what? 12. What is the deferred tax? It is the difference times the rate of tax. How much? 3,600. Maybe put this point somewhere. When the tax base is more than the carrying amount, when the tax base is more than the carrying amount, we have deferred tax asset. Sometimes that is a question which is asked. When do we have deferred tax asset? When the tax base is more than the carrying amount, we have what? Deferred tax asset. It is treated as a non-current asset.
Write it above.
Yeah. When, maybe write it here. When,
yes.
When tax base is greater than carrying amount, we have deferred tax what? Asset. Treated as non-current asset in statement of financial position. When tax base, or let me put it this way, when carrying amount is greater than tax base, we have what is called deferred tax liability, treated as non-current liability in statement of financial position. I hope that is clear. Let us continue. Now, year 3, year 2.
Okay, let us finish that one.
Just allow me to extend with 10 minutes so that I finish what I'm covering. Do you allow? Okay. So
yes, of course.
I'm just giving you time so that you put down that, yeah? I hope you've put it down. Now, let's continue. Carrying amount at the end of year 2. What will it be? It will be 40. We agree. Minus tax of year 1. Sorry. Depreciation of year 1 plus depreciation of year 2. We agree? So what is it? 20. What is tax base? Cost of year 1.
Can you repeat that one?
Okay. Year 1. What is the carrying amount? Cost of the asset minus depreciation of year 1. Can we please keep kids away when you're asking a question? So we are saying year one is cost of the asset minus the depreciation of year one. It gives you the carrying amount. Year two, cost of the asset minus depreciation of year one minus depreciation of year two. That is what we call accumulated depreciation. The person who asked, have you understood? Year three, let me finish with the years first. Year three is cost of the asset minus depreciation of year one plus depreciation of year two plus depreciation of year three. Year four is cost of the asset minus, we are in year four, depreciation of year one plus depreciation of year two plus depreciation of year three plus depreciation of year four. Year five, it is 40,000 minus depreciation of year one plus depreciation of year two plus depreciation of year three plus depreciation of year four plus depreciation of year five. The asset is fully depreciated. So the carrying amount is 0 in year five. Let us come to tax base. Year one tax base is cost of the asset minus capital allowance in year one. Year two, cost of the asset minus capital allowance in year one is 20,000 plus capital allowance in year two is 5,000. Did you see from year two the capital allowance changed? Did we see that?
12.5%.
Yes, thank you. 12.5%. It gave us 5,000. So we have 15,000. Year three. Can somebody guide me in year three? 40,000 minus 20 plus
5 plus 5.
So year four, 40 minus 20 plus 5 plus 5 plus 5. Year 5, 40
minus 12
minus 20 year 1
plus 5
year 2 5 year 3 5 year 4 and 5 year 5. So what does that give you? 0. Now, what is the difference? I'll just scroll down. Difference is the difference between carrying amount and what? Tax base. What is the tax rate? Deferred tax is what? 30% of the difference. Have we understood there? Up to there, I hope we are together. I'm repeating.
Yeah.
How do we get the difference? It is the difference between carrying amount and the tax base. How do we get deferred tax? Deferred tax is the difference and the tax rate. What is deferred tax? Deferred tax is called future tax. Now, how do we account for deferred tax? You see, in year 0, the deferred tax was 0. Do we agree?
Yes.
In year 1, the deferred tax was 3,000. So we can see that there is an increase from year 0 to year 1. The increment is how much? 3,600 minus 0. So that gives you how much? There is an increment 3,600. Now, when you find that deferred tax, this statement is very common in published accounts. When you find that the deferred tax has increased, I don't know how I can bring out this. When you find that the deferred tax has increased, you find this increment of 3,600, the increment of 3,600, the increment of 3,600, you take the increment of 3,600, you add it to the current tax. I'm repeating. When you get, there is an increment. You take the increment of 3,600, you add it to the current tax. How do we get the current tax? Estimate of the year. Do you remember estimate of the year? Plus under provision, under estimation. Do you remember that? Estimate of the year plus under provision. Now, that the answer you get is the income tax, but that is called current tax. So you take that current tax, you add it to the 3,600 when you find there is an increase. 3,600 being deferred tax. When you find there is a decrease, for example, in year 2, you see in year 2 there is a decrease.
Yes.
Year 2 there is a decrease of how much? 3,600.
900.
What? So there is a decrease of how much? 900.
900.
When you find there is a decrease, to calculate current tax, you minus the decrease. Are we together?
Can you note it somewhere, please, so that you can remember when we are revising?
Okay. When there is an increase in deferred tax. Are we together? Add it to current tax. Are we together? When there is a decrease in deferred tax, less it from current tax. How do you get current tax? Current tax is equal to estimate of the year plus under or minus over estimation. You know what I mean by that because you have covered an example.
Yes,
Are we
yes.
together? So please, this is all questions on deferred tax. This is what they test on. That is what they test on. They want to see, once you have known what is the deferred tax, what is its effect? What is its effect on what? Income statement. What? Now, please note, this 3,600, this 3,600 increase, what does it do to the current tax? What does it do when it's an increase? It increases. Okay. When it is a decrease, what does it do?
Decreasing.
Now, that is in the income statement. But in the balance sheet, you just take the whole amount. In the balance sheet, you take the whole what? Amount. So which means the whole amount, 3,600, I should see your non-current liability. I should see your non-current liability of 3,600 in year 1 as deferred tax. Why is it an non-current liability? Why is it an non-current liability? Because the carrying amount is more than the tax. Yes. Because the carrying amount is more than the tax base. As I finish, what I want to say is, in the income statement, what do you do in the income statement? In the income statement, current will be tax. Do we agree? Plus what? Increase in deferred what? Deferred tax. That is the amount of tax. In the statement of financial position, take the whole deferred tax, the whole deferred tax as a non-current liability. When is it? When carrying amount is greater than tax base. Again, in the statement of financial position, the deferred tax is an non-current asset. Is an non-current when tax base is greater than carrying amount. That is introduction to published accounts. So on Friday when we meet, we will see how to prepare now published accounts, and then we will continue from there. Remember, we must prepare financial statements of 5 different companies. There is the normal published accounts, there is insurance stroke banks, there is professional firms, there is agriculture, that is farming, there is what else? Which one am I leaving? Public sector. So let us stop there. We meet Friday at 6:30 online.
What is that?
Now the person saying sorry.
Sorry. We need the Excel.
We need video.
No video. Video, please go and read the one on income tax. Remember IS 12. That one explains everything. The video I shared on IS 12. The video I shared on IS 12 explains everything I've talked about. Are we together?
This Excel.
Yes, this Excel I'll share with you.
Okay.
Okay, fine.
Sorry.
Have a good night, all of you. See you on Friday.
Have a